Welcome back to the deep dive. Today we have a pretty substantial document. It's a 2024 financial report for International Container Terminal Services, Inc., or ICTSI for short, ICTSI. And well, we want to really dig into this thing and extract like the really key info, and I think especially focusing on their operations all over the globe, worldwide, and their financial health. How are they doing as a business?
Yeah,
And we'll look at, their strategic moves, their market position, and how they deal with, I mean, this is a complex business, moving goods all around the world by sea. So this is think of it as like your personalized breakdown of this report, what really matters.
absolutely. Looking at this, flipping through it, we've got audited financial statements, right?
Yeah.
We've got management discussion and analysis, so we can hear from the horse's mouth, right? Details on all their various terminals around the world. And then, you can see how they've been doing over the last few years, really culminating in this, 2024. But yeah, we want to synthesize all this and come up with like a really clear picture of, where they stand now and where they might be going in the future based on what we're seeing here in black and white.
Okay, so let's start big picture. So, this is a company with a very global reach.
Very much so.
So what's the footprint look like?
So they've got a network of container terminals in, all over Asia, the Americas, and then EMEA, Europe, Middle East, Africa. And their strategy seems to be focused, at least in large part, on emerging markets.
Emerging markets, so places that are developing rapidly.
Exactly. That's often where you see the most significant growth in trade volumes. Think about regions that are industrializing rapidly, their populations are growing, their middle class is expanding. And then the beauty of it is, compared to more established markets, the competition in emerging markets can be a little less intense. This allows ICTSI to get in early, potentially really good partnerships as new infrastructure is being developed.
That makes sense. And it's not just about being present in a lot of places. It's about their position in those places, right? And it seems like, a lot of their major terminals, they're not just there. They're the dominant players, the market leaders in these specific regions. And often it seems like, these are end destination ports, the final stop, which I imagine gives them quite a bit of leverage.
Absolutely. Yeah. If you think about it, if they're the primary gateway, the primary port serving a particular market, well, customers, importers, exporters, they don't have as many alternatives. They can't just easily switch to a competitor down the road because often there isn't one. And the report uses the term pricing confidence, which I think is a nice way of putting it. It really reflects their strong market position in these key regions.
Yeah, that's interesting, pricing confidence. So they call out specifically, some of these major terminals like Manila International Container Terminal, MICT,
Right.
here in the Philippines. And of course, Manila being, I imagine, historically hugely important to ICTSI's overall revenue.
Without a doubt, yeah. MICT is their flagship operation here in the Philippines.
Okay, so MICT, then they talk about Condacan, Guayaquil, SA, CGSA in Ecuador,
Right, good.
and the Baltic Container Terminal, BCT, in Poland. So truly spread out all over the world.
They're global. Yeah. And that's not just, for diversification, for the sake of diversification. They explicitly say this helps to mitigate the impacts of, if one region's economy takes a downturn, it doesn't cripple the whole business. And what I found particularly interesting is their terminals continue to operate and generate revenue, even during, the global pandemic.
Yeah.
That says a lot about the resilience of their model, the essential nature of, global trade and moving goods.
Yeah. I mean, I remember during that time, even when everything else seemed to be shutting down, those ports were still humming.
Exactly.
Yeah.
The ships kept coming, the cranes kept moving.
Yeah.
Essential services.
Yeah. Okay, and then looking ahead, they're not sitting still.
No.
They're actively looking for new investment opportunities, right? And they talk about how their balance sheet and liability management put them in a good position to do that. So basically, financially, they're in a solid spot to grab those new opportunities.
Very much so.
Yeah.
I mean, a healthy balance sheet, that's the foundation.
Yeah.
And you see that. They're proactive about managing their debt maturities, their interest schedules, so they're not caught off guard. That really points to financial discipline, which is always a good indicator, especially for long-term investors.
Right. You don't want to see a company that's over-leveraged and suddenly can't service its debt.
Exactly.
Okay. And then one more thing on the big picture strategy, they emphasize that they focus a lot on cost control. And, combined with that pricing confidence you were talking about, that must really help them maintain, healthy profit margins.
Precisely. Cost control is so essential. And they're not just talking about, cutting corners. It's about efficiency, optimizing operations, and making sure they're getting the most out of every dollar. The report emphasizes that this is an ongoing priority across the entire group. It's not just, a one-time thing. They're constantly looking at it.
Right. And in an industry like shipping, which can be pretty cyclical, tied to global economic conditions, having that strong cost control could really be what helps you ride out those ups and downs.
Absolutely. It's all about weathering the storms.
All right, so that gives us a good sort of overview of their strategy, their reach globally. Let's zoom in now on 2024 specifically. It looks like it was a pretty eventful year.
It was a lot of activity. We see new contracts, expansions. They won that 25-year contract to develop and operate the Iloilo Commercial Port Complex, ICPC, right here in the Philippines. That's a big win. And they got the notice to proceed in April 2024.
So that means it's a go. They're already moving on this.
Project is underway, yeah.
Okay. And then in Indonesia, they were active there as well.
Very much so.
So their subsidiary, ICTSI Far East, they signed an agreement in Jakarta in January 2024.
Right.
And the East Java Multipurpose Terminal, EJMT, started handling containerized cargo after finishing a new deep water berth October 2024. So that sounds like a big upgrade to their capabilities there.
It is. And they're building on an existing strength. EJMT already has a strong foothold in the barge operations market in East Java. 41% market share even before this new berth came online. So that suggests they're well-positioned to expand into the containerized cargo business there.
Yeah. I mean, if you already have that kind of presence, the relationships, the infrastructure, it makes sense to leverage that.
Exactly. It's about building on what you already have.
Okay. So Indonesia, then moving over to China, their Yantai International Container Terminal, YICT, became the sole operator at the Zifu Bay Port area in Yantai.
A significant move.
Yeah, becoming the sole operator, that's a consolidation of their position.
Absolutely. It streamlines operations, potentially gives them more influence over future development at that port.
And it reduces competition. Right.
Well, eliminates it.
Yeah.
In that particular location, at least.
Yeah, okay. And back here in the Philippines, at their main terminal, MICT, Manila, the development of Berth 8 continued, and they talk about adding significant berth length and container yard capacity in phases, first by late 2025 and then 2027.
That's a big capacity increase.
Right.
So, we talked earlier about MICT being their flagship terminal, historically very important for their revenues.
Right.
This expansion shows their commitment to this key terminal, that they're anticipating continued growth in traffic, they're putting their money where their mouth is.
They're betting on the future. Okay,
Yeah.
so new developments, but also they secured a 25-year extension for their Mindanao International Container Terminal Services, MICTSI, extending their operation there all the way to 2058. Long-term commitment.
That kind of long-term agreement, it provides stability, encourages continued investment in those facilities.
Yeah. And then back to Indonesia once more, PT Lamongan Integrated Shore Base granted a 7-year extension to EJD's operating rights until the end of 2072. So we're seeing this theme really securing their long-term rights in these key regions.
Absolutely. These extensions and new contracts, they paint a picture of a company that's really focused on solidifying its existing positions, strategically expanding its reach in those important growth areas.
It's all about that long game. Okay, so let's shift gears a bit and talk about their market share and competition. Where they operate, how do they stack up against the other players?
Yeah, the report gives us some good insights into that. For example, in Papua New Guinea, it seems like their Motuki International Terminal and South Pacific International Container Terminal, they operate exclusively in their respective markets. So no direct competition there.
Wow. Okay, so that's a very strong position.
It is. It allows them to really shape the market, set the terms.
Okay, and then in Brazil, their Sepetiba Tecon, it looks like they have a very dominant market share in containerized cargo, 56%. That's huge.
56%, that's a commanding position.
Yeah.
And Brazil is a major player in South America, a huge market.
Right.
That kind of market share, it gives ICTSI leverage in negotiating tariffs, maybe even influencing infrastructure development plans. They're a major force there.
Okay, then in Colombia, Buenaventura, it seems more competitive. Their Sociedad Portuario Industrial Agua Dulce, SPIA, handled about 45% of the volume in 2024, but they're competing with terminals operated by a major shipping line and another regional port society.
Right, so a more typical competitive environment where you have to fight for every bit of market share.
Okay, so 45%, still a significant chunk.
Absolutely. It shows they're holding their own against some tough competition.
Okay, then in Egypt, Alexandria, their Barcelona Container Terminal, BCT, has about 18% market share. And they're up against DCT and GCT, which are pretty big players. So that's a different story.
Yeah, 18% in a market dominated by two much larger players. That suggests BCT is probably operating in a niche, maybe focusing on specific types of cargo or services, competing on factors beyond just volume.
Right. They have to find their edge.
Exactly.
Okay, then we have Madagascar, and it seems like their MICTSL, they're pretty much alone in the container market there. No major competitors.
That's a very favorable position. Being the primary, if not the sole, operator, it gives you a lot of advantages in terms of pricing and how you develop the market.
Yeah, you're kind of in the driver's seat. Okay, then in Georgia, Batumi, their Batumi International Container Terminal, BICTL, captured about 14% of the market, with the rest handled by a Poti Seaport. So again, a smaller player alongside a larger one.
Similar to Alexandria, it seems like BICTL is likely focusing on a specific segment or leveraging its particular strengths to compete with the dominant Poti Seaport.
Got to find a way to stand out.
Exactly.
And finally, in Croatia, Rijeka, their Adriatic Gateway Container Terminal, AGCT, is the smallest of the three main terminals there. So that sounds like a more challenging environment.
It does. Being the smallest player often requires a very focused strategy to carve out a sustainable and profitable position.
All right, so we see the whole spectrum here, from almost monopolies in some of these emerging markets to really tough competition in some of the more established ports. Okay, let's switch gears again and talk about the numbers, the financial performance in 2024.
All right, let's dive into the financials.
So one thing that jumps out is the interest income, up significantly, 23.4%. And they mainly attribute that to interest earned from their short-term investments and also the benefit of higher average interest rates. So that's a nice boost.
It is. That extra income can really help, especially in a year where maybe other parts of the business are facing headwinds.
Right. And speaking of headwinds, it looks like the revenue side was a bit more complex. Gross revenues were affected by, new terminals coming online, discontinued terminals, changes in volume, and of course, those ever-present currency fluctuations. So it's a reminder that even a big, strong company like ICTSI, they're not immune to those global macroeconomic forces.
Absolutely. And the report specifically mentions an unfavorable impact from the weakening of the Brazilian real, the Nigerian naira, the Mexican peso, even the Philippine peso. So you can imagine if a large chunk of your revenue is in these currencies
Yeah.
and they weaken against your reporting currency, which is likely the US dollar, that could really eat into your top line when you translate it back.
Yeah, that makes sense. Okay, and then operating expenses, they saw an increase there as well, driven by things like higher volumes, the costs associated with new businesses, increased spending on repairs, and once again, those unfavorable foreign exchange effects.
It's natural to see operating expenses increase as your operations expand and as you integrate new ventures. The key is whether those increases are proportionate to, or ideally lower than, the growth in revenue.
So are you getting more efficient as you grow?
Exactly. And the mention of increased repairs, that suggests a focus on maintaining existing infrastructure, which is important for the long-term health of the business.
Okay, so revenue and expenses, and then the report also talks about how they manage their cash flow, emphasizing that cash generated from operations is a primary source of funds. They also utilize borrowings and manage capital expenditures, so it seems like a pretty balanced approach.
It does, relying on operating cash flow, supplementing that with strategic borrowing and capital spending, that's a good sign.
Yeah, you want to see a company that can generate cash from its core business. Okay, and then finally, in the financial highlights, they note that receivables increased, which is linked to higher revenues. On the flip side, loans payable decreased, which they attribute to net payments. So it seems like they're managing their debt well.
Yeah, generally, an increase in receivables along with higher revenue, that's normal. You're extending credit to customers for services you've already provided. And the decrease in loans payable, that suggests they're actively paying down debt, which is a positive sign.
Yeah, gets those interest payments down. Okay, so we've covered their financial performance. Let's talk about something that's really crucial for any international business, and that's risk management. So what are some of the key risks that ICTSI highlights in the report?
They cover a lot of ground, which
Hmm.
is good. You want to see a company that's really thinking about all the things that could go wrong. Foreign exchange risk is a big one. They acknowledge that a large portion of their revenues is linked to, non-US dollar currencies, so the ups and downs of exchange rates can really impact their earnings.
Right.
They try to manage this by matching revenues and expenses in the same currencies where possible, And sometimes they use hedging strategies to protect themselves.
Hedging, so basically trying to lock in exchange rates.
Exactly. Trying to minimize their exposure to those fluctuations.
Yes. Okay. So foreign exchange, then they talk about interest rate risk.
Yeah, this is mainly related to their bank loans. If interest rates go up, the cost of those loans goes up too.
Makes sense. So how do they manage that?
Well, they periodically review their debt mix, looking for opportunities to reduce interest costs, secure favorable loan terms.
So always looking for a better deal.
Exactly. Refinancing, renegotiating, always looking for ways to optimize.
Okay. Then there's liquidity risk, making sure they have enough cash on hand. I mean, that's crucial for any business, but especially one with big ongoing operations and capital expenditure plans like ICTSI.
Absolutely. You've got to keep the lights on and the cranes moving. So they monitor their cash levels, they maintain access to bank credit facilities, and they have this policy of trying to keep less than 25% of their borrowings maturing within a 12-month period, though they do say they're reassessing that given their current growth plans.
So they might need to adjust that as they expand. Okay. Then there's credit risk, the risk that customers won't pay them. How do they deal with that?
They're careful about who they extend credit to, and in some cases, like in Indonesia, they operate on a cash-on-delivery basis for certain cargo owners. So they're not taking on unnecessary risk.
Cash is king. Okay, then they talk about operational risk, which I imagine covers a pretty wide range of potential problems.
Yeah, it includes things like systems failures that could disrupt their terminal operations. These days, these terminals are highly automated. They rely on technology for efficient container handling. So any kind of disruption can have a big impact.
Right. And then there are the big ones, catastrophic events, the impacts of climate change.
Yeah, their facilities are exposed to natural disasters. They specifically mentioned the Philippines, typhoons, earthquakes. Those could shut down MICT, which is a major revenue generator for them. And then there's the broader risks associated with climate change, rising sea levels, more extreme weather events.
Yeah, those are risks that are hard to predict and hard to control. Okay, so natural disasters, and then there's the regulatory environment.
Yeah, government regulations and licenses, that's a key risk area for them, operating in so many different countries. Compliance is paramount. They have to stay on top of all the local laws and regulations.
And the consequences of noncompliance can be pretty severe, right?
Absolutely. Penalties, fines, even loss of operating concessions. It's a big deal.
Okay, so regulations, and then of course there's competition.
Always a factor. As we discussed earlier, they face different levels of competition in different markets, but increased competition could lead to lower volumes, pressure on their market share.
Right. And then they mention the challenges of integrating acquisitions. I mean, they're actively growing through acquisitions, so that makes sense.
It does. Bringing a new business into the fold, making sure it operates smoothly, maintains their standards, that takes careful planning and execution.
It's not just about buying something, it's about making it work.
Exactly.
Okay. And finally, they talk about reliance on key personnel. Specialized skills, experienced people, those are hard to find.
Absolutely. In a highly technical industry like port operations, having those skilled people is essential. The risk is if those key individuals leave and you can't readily replace them.
So you've got to keep your best people happy.
Absolutely.
All right, so a really comprehensive look at the risks they're facing. Let's wrap up with a few other interesting points from the report. They highlight that the ICTSI name and logo are registered trademarks, which is a reminder that their brand has value.
It does. A strong brand builds trust and recognition.
Okay. And they have a pretty extensive insurance program covering everything from property damage to political violence risks.
That's a smart move, given their global footprint and the range of risks involved.
Yeah, it's about protecting yourself. Okay, and then they talk about health and safety. They've implemented a health and safety management framework across all their terminals, which is good to see.
Absolutely. A focus on health and safety, it protects the workforce and contributes to operational efficiency.
And they have collective bargaining agreements in place at various terminals, which outline things like employee benefits and working conditions.
That indicates a structured approach to labor relations, which is important for maintaining good relationships with their workforce.
Okay. Then they acknowledge the impact of global trade and economic developments, which is something we've talked about quite a bit.
Yeah, their business is tied to the flow of goods around the world, so anything that affects global trade affects them.
Okay, and then they mention that they're involved in some legal cases and negotiations, but they don't believe these will have a significant negative impact.
That's a common disclosure in financial reports. The key is their assessment that these matters won't materially harm their financial position.
Okay. Then they get into the structure of their shares, different classes of shares, common shares, preferred A shares, preferred B shares. which are non-dividend paying, voting, and held by Philippine nationals. That's interesting.
It is. The preferred B shares, being non-dividend paying but voting and held by Philippine nationals, that probably relates to specific ownership regulations or strategic control considerations within the Philippines.
So a bit of local context there. Okay, and then they talk about related party transactions, dealings with entities they have a close relationship with, joint ventures, common shareholders. That's pretty normal for a large company.
It is, but it's important to make sure those transactions are done fairly and benefit all shareholders.
Transparency is key. And finally, it's good to see that they've set some sustainability goals, 2030 emission reduction targets, and aiming for net zero emissions by 2050.
Definitely a positive sign.
Okay, so we've covered a lot of ground here. What are the key takeaways for our listener?
Well, I think the main thing is that ICTSI is a company with a clear strategy. They're targeting growth markets around the world. They're building strong positions in those markets. They're actively expanding their capacity, and they're managing their risks.
Hmm.
It's not all smooth sailing, of course. They face challenges from currency fluctuations to competition to, the ever-present uncertainty of the global economy.
Right. So they're a major player, but they're not invincible.
Exactly.
And what are some things, for our listener to think about as they go forward, after this deep dive? What are some areas they might want to explore further?
Well, it'd be interesting to compare their performance across different emerging markets. Where are they really excelling? And then you could track the progress of that Birth 8 development at MICT, see how that impacts their capacity and efficiency in Manila.
Mm-hmm.
And of course, with those sustainability commitments, it'll be interesting to follow their progress in that area, specific initiatives in green port operations.
So lots to keep an eye on.
Absolutely. This is a dynamic company operating in a dynamic industry.
All right. So here's the final thought for you, our listener. Given ICTSI's reliance on global trade and their expansion into so many different regions, how might shifts in global trade policies, big geopolitical events, how might those things really impact their future in ways that go beyond the numbers we've talked about today? Something to ponder. Thanks for joining us for this deep dive.